But the 15-day is showing us negative correlations across the indices, the currencies, and those negative correlations could create a weakness inside of those markets if the dollar continues to strengthen. The dollar's monthly chart here, we have had these massive dollar pullbacks about every 4 years. Interestingly, they do happen to correlate with the crypto beginning of the crypto winter as well too. Now they affect the indices in differing forms throughout this last 15 years, but the beginning of this year, there is a potential very similar to what we had at the end of 2021 to have a dollar strength trade, and that to negatively affect the broad markets in general. And when you look at the daily charts, you can see here this massive double bottom that we have here, and then a pullback that was defended as we have come out of the 11th of February. And then inside of that February 11th pullback, we defended pullbacks here coming out of last week, Tuesday, and then again coming out of the beginning of this week. The dollar is starting to rally. Now, it's important that the dollar's rally is understood in relation to, nominal versus real. Nominal means that it's strengthening to the other trash fiat currencies of the world. They're all fiat, all value by decree. In real terms, for which the stuff that they can actually buy, it takes more and more and more of all the currencies of the world to buy those actual hard assets, the commodities. And so we're talking about nominal strength, not real strength. Incredibly important to understand that. As the dollar continues to strengthen, that is a headwind for the broad markets. Bank broke down yesterday and is inside of 50% retracement shorts. It could potentially even be going straight down in extensions. That's an incredible headwind against the indices. And then the VIX, in its brand new contract, has been defending pullbacks. Now you'll note here that the VIX has not broken out of its resistance. It is stuck between two opposing setups. The VIX is the only instrument right now that would suggest that there's still a battle over the trend, that there is still a case for the bullish case for the indices right now. But our other two leading indicators are suggesting something else, that there's a weakness that's potentially coming. And so what we're doing here is we're trailing the VIX series of longs. And the long setups are holding and defending above these 1940s. And as long as they are, then there's a weakness inside of our markets in the intraday timeframes. We've even been watching here that our Monday's lows to highs could potentially continue a rally and continue to create that weakness. So think about this. The signs of a turning point, we have the dollar suggesting an indice downtrend, bank suggesting an indice downtrend, and then the intraday timeframes, the VIX suggesting an intraday downtrend. And until the VIX breaks through its its long setups, the indices are going to keep on weakening. They're going to keep on selling off. And that support level in the VIX that we're watching here is the 2060. The inverse of that setup is the resistance level. And you'll notice here that these 38.2% lines are very tightly correlated. The 38.2% line, the 2075, the 38.2% line of the ES, this 68, 70, 50s. This was also the 20 handle. What is the significance of the 20 handle? The 20 handle, there's a 72% probability for filling a gap. This stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.